Y'all, this week we've got some inflation reads that should have just blown the bond market through the ceiling in price and pushed interest rates dramatically lower. We saw a CPI number that came in shockingly low earlier this week, and it was backed up, frankly, by a much lower than expected producer price index that came out yesterday. So, how much did the bond market rally in order to lower interest rates for us all, as these reports would normally want to do? Well, not much, y'all. Let's dive into the numbers, and then we're going to talk about why and how that might change in the near future. Mortgage News Daily, 30-year fixed rate conforming loan. This is the national average, y'all. 6.68% today. We were at 6.65% a week ago. So even though we had these dramatically better reads on inflation, we're actually a hair higher in the national average this week than we were last week. We're also nearly a quarter of a point higher than we were a month ago. We were at 6.54 30 days ago today. Y'all, the low for the last 30 days was 6.52 on the 29th of June, and the high for the last 30 days was 6.75 back on July 13th earlier this week. So obviously what has moved the market, y'all, and what kind of deprived us from a rally over those much better than expected inflation numbers is renewed tensions with Iran. The fighting has escalated and fully resumed. Any peace accord or ceasefire agreement has been scrapped at this point. So the bombs are going to continue to fall for a bit until the parties can get back to the table. However, when they do, y'all, the underlying strength of these reports on inflation should price a bit of a premium back into the bond market, and the economic reality that prices are not escalating wildly is going to come back into the equation. Here's the thing, y'all. The Fed can only moderate inflation that is driven by consumer demand. They can't do anything about inflation that's driven by supply side interruption. All of the price increases that we've seen since the Iran war started are due to supply side disruption. They're due to higher energy costs associated with less oil being on the world's marketplace. Because of that, y'all, the Fed is going to be discounting to a degree, or attempting rather to get data that strips out to a degree that volatility supply side equation so that we can focus on the demand side of this equation. How much inflation is baked into the economy that is being driven solely by overheating consumer demand, right? That is the equation and the question that the Fed has to answer. Well, when you look at Fed futures, just based on where inflation has been, there is a 10% chance of a hike going into the July 29th meeting at the end of this month. There's a 55% hike, y'all, priced into the September 16th meeting. That's the next meeting after the one this month. I still think that the Fed futures are pricing in more of a premium on a price hike by the Fed. I just don't see it, y'all, especially since Kevin Warsh is well aware that these are supply side disruptions far more so than demand side strength. That strength is frankly just tepid at best based on every read that I have in the marketplace. So I think the Fed futures are a bit overblown on pricing in Fed hikes in the future. But y'all, I could be wrong. There's a lot of smart people that are pricing those futures in place. So here's what it means for us, y'all. I don't want to get too far in the weeds on what these numbers mean week over week for a buyer that might be contemplating a purchase. The bottom line is you can afford what you can afford, and we can approve as the lender what we can approve. A lot of folks have a misconception about what that process looks like. Y'all, if I get an application from a borrower by 3 p.m. on any given day, I'm likely turning that around into a full approval with a letter in your hand within 2 hours. You'll also have a preliminary approval from estimate from me as well, based on the sales price and the product that we've discussed that might be best for your scenario. So you're going to have a lot of questions answered in a really short period of time. I think a lot of folks think that when they apply for a loan, that they've got some multi-day or multi-week process ahead of them for a preliminary approval. That's not true at all, y'all. Preliminary approvals, pre-approvals, pre-qualifications go by very quickly in today's world. And y'all, I'm backing that with 34 years of experience doing this. So I'm confident that when I put something in front of you, it's going to be something you can take to the bank. So in any event, I just wanted to dispel the notion that this takes a long period of time to get done. It really doesn't. And the process is very methodical and easy. It literally walks you through every stage that's needed. You can submit an application in 15, 18 minutes, and then I can be on the ground and running on my end to get you the answers that you need. In any event, I hope this information is helpful for you and for the agents that are attending this video. I hope it's helpful for your clients. Always happy to help, always honored to have your referrals. Stay blessed, stay safe. We will talk to you next week.